Hello and welcome to a special show, The Big Call. The world is talking about the three C's: China, currency, and commodities. I want to add one more, which is chaos. How should one invest in this kind of a chaotic environment? To answer that and to put things together, I have with me the perfect guest, someone who indeed has been a big wealth creator for retail investors. Fantastic to have you back, Madhu, on ET. Thank you for joining us.
Thank you, Nikunj. It's always great to be here.
Oh, what a year it's been.
Yeah.
You look at the screen and you say 20% down in mid-cap stocks, 10% down in large-cap stocks. Everything is melting away. No one saw this coming.
I would not say that no one saw this coming, Nikunj. I'm not saying perfectly that I saw it, but somewhere in the gut it was there that in some of the mid-cap companies since last 2-3 years we've been seeing some kind of a euphoria being built up, because there's so many new investors, so many new people who have come, market was crazily following up. And we have seen many phases of market. Whenever money making becomes so easy that you come in the market, you look at some website or you look at someone's tweet, you buy shares and you make money. I wish it was so easy to make money, So in the mid cap and the small cap space, I think some amount of euphoria, some amount of frenzy was very, very clearly visible.
So Diwali has now become Diwala for mid cap investors.
No, I wouldn't say that. Again, if you see the to categorize all companies under one trade, that is also not good. So I would not say all mid caps have a problem. I would say that there is selectively, wherever there were too much euphoria and all the stories were there, obviously they have corrected a lot. And I spoke in the beginning of the year with some other channel that China is a clear issue, and one was not expecting that China will correct 25% in 10 days, but that gut was there that somewhere that what was going on there also was not sustainable, and it has indeed corrected. So I wouldn't say that people were very surprised by this move, but there was the accentuation of fall. It's been clearly surprised a lot of people.
Madhu, the fact that China is shifting its business model, that's old news. Crude is in an epic bear run, that's yesterday's data. The fact that world growth will be challenging in 2016, that's well discovered. The economic data this year has not worsened, yet markets are nervous. So what explains this volatility?
This is a brilliant question. Let me just explain, take a minute and explain. See, what has happened because of this fall in crude prices, the countries which were essentially big suppliers of crude, they had all the sovereign funds, and they were the people who were supplying money to financial markets. Okay. So our estimate was that at $100 and above, this money was $1.5 trillion, okay, which was going into this producing countries of oil, and significant portion of that was coming into financial markets. I'm not saying only equity market, whether it is bond, this, that. Now, at $30 or $40, that is roughly $450 billion. So, effectively speaking, $1 trillion of liquidity is being taken away because of the fall in oil. Now, the argument is that ultimately it is going somewhere, that it is going to consuming countries and it is boosting their economy. But it is not a one-on-one relationship with the financial markets. Because when this money goes away, it goes away from financial market. When it comes in, like Madhu Kela is saving on his petrol bill, but he is not putting money in the stock market or in the financial market. I may be putting money somewhere else which may have its impact, but it is not one-on-one proportion. This may have a very delayed impact, while that sell-off is having impact as of now. So I tweeted the couple of days back.
Friday morning to be precise.
Right. So I am saying that crude is the most important thing for global markets stability, and we believe that maybe bottoming out of the crude oil prices have started. I'm not expecting a bull run. I'm not saying the crude will go to $100 again, but at this $25, $27 of crude oil prices, there are a lot of non-OPEC countries which will start to make cash losses. A lot of the shale oil which came in US, Canada, that will start to make cash losses. Now, the oversupply is only 1.5%. If 1.5 million barrel every day, in terms of money, it is $10 billion, and that is eroding market caps and valuations and every day of $10 billion worldwide. So I think, and to my mind again, is it a problem which can't be fixed? It can easily be fixed. Cutting production of crude by 1.5 million barrel is not a big deal. But why is it not happening? I'm not an expert to say. But again, since I told you I'm not a crude oil expert, but I can feel as an investor that at $25, $27, $28, there is very limited downside in crude. And in this year, maybe in the second half, you will start to see some improvement, and that should stabilize at least some nerves in the international markets.
Now, Nigeria has put a ban on forex control.
Sure.
Abizan is saying that you will have to pay 20% taxes if you're taking money out of that country. To your mind, the adjustment of crude in this new world, is that over, or the crude adjustment will be an ongoing process, whether that happens at a country level, whether that happens at a sovereign fund level, whether that happens at a liquidity level, is that behind us?
No, it's not behind us. Because
it is still coming.
It is coming. The pain will be felt. That if you take for instance Nigeria or countries like Venezuela, when a significant portion of their income was coming because of crude, and Nigeria has $29 billion of foreign exchange reserve. Venezuela has only $5 billion of foreign exchange reserve. While the crude loss, absolute loss between $100 and $30, $40 of crude price is significantly larger than the foreign exchange reserve which they have. So they have only two options: A, resort to borrowing. To countries like Saudi Arabia, the world will be willing to lend, but is there enough dollar liquidity which is available for Venezuela? The answer is no. If there is enough dollar liquidity available for Nigeria, the answer is no. So some of these countries, and that is what my argument is, that if the crude oil prices stays here at $25, $30, then some of these countries will feel accentuated pain, which has to get reflected in the worldwide financial markets.
Now, on paper, we can prove that India is the biggest beneficiary of decline in crude prices.
Absolutely.
So we are in an enviable spot right now.
Absolutely.
Local growth is coming back, and globally things are on our side. Yet Indian markets are suffering
because of the financial impact.
Okay.
So the point is the economy. It's a fantastic news for economy. But as I explained to you, once liquidity gets sucked out on the overall global, the selling number by foreign financial institution investor is nothing else but the explanation that all this sovereign money which came into India in the last few years because of high crude oil prices, since they are feeling the pain, they are withdrawing the money. And in the short term, market is demand and supply. If the supply is more, then obviously markets will feel the punch. And that is what explains. Apart from the fundamental recovery which is taking more time than required in India on the sense of earning growth. We are not talking about economy right now. We are talking of earning growth. Because the last 2 years we have been saying that this year will grow at 20%. But eventually, by the time the year ends, the growth comes down to 6-7%. So I am hoping that sometime this financial impact, if the crude prices recover, sometime the financial impact will be significantly lesser in terms of outflow of money from the Indian market, and that should be a great news for the markets here as well.
Is the current market setup or compression or volatility a long-term investor's great friend? Right now we are calling it risky, but do you think this is volatility, this is not risky, like you told me in Diwali, that embrace volatility and this is what we've got?
So that is what my call is, that let's say supposing is the long-term India story intact? I can thumb the table and say that the long-term India story is intact.
Why is it intact?
Because as you rightly said yourself, that the crude prices are coming down. It's a fantastic news. $1 of crude equals 1 billion of saving for India. And if you have had, let's say, last year, your average was $86, $87. This year, your average is $50. So you have not yet felt fully the impact of $25 and $30 of oil.
But bulk of the crude benefit is being gobbled up by government of India. It's not coming to the end consumer.
Somewhere it is helping the economy. No, I think half of this is being passed on to consumer and half is retained by the government, which actually is a good thing. that, fiscally they're able to make their situation much better. And plus, Nikunj, I think, all the work which is being done in India, coupled with the fact if the globally things are going to be so challenged, which are the economies which have a potential to grow at 8 to 10%. So I would say once the dust settles down, then you see a lot of flows, even on FDI front in India. So there's nothing which has changed, just because markets have corrected by 15-20%, we can't say the India bullish story is gone.
Actually, so the bull market is still intact?
Bull market is 100% intact. If it was not intact, I will not be giving you interviews.
No, you've spoken to me in bear market as well. But
no, not bear market. I am saying if the long-term bull market is not intact. I say we are all here because there is a hope that we are in a real long-term bull market.
So this is just a structural correction?
This is a structural correction which may last couple of months, because once markets fall, specifically globally, there is a consolidation which can happen, and few people are arguing that this is a fresh bear market. Where is the fresh bear market? For 2 years, Nifty has not made any return.
So this is not 2008. Let's be very clear on this.
I see. We have to watch the global events.
Okay.
I am not saying whether it is 2008 or it is not 2008. At this point of time, as things stand, it doesn't look like 2008. At least for a country like India.
What should an average retail investor do? Because frankly, in last 5 years, they've only bought real estate and gold. They came back in 2014 and 15, and the year they came back, the very next year, which is 2016, they've lost money.
So Nikunj, I think, in equities, you cannot evaluate your performance based on 6-month return, because equity investment is not supposed to be made specifically by retail investors for 6 months or 12 months. When you buy a piece of land, do you go and check with your real estate agent what is the price of the piece of land every 3 months? When you buy gold, do you check what is the price of gold every month with your jeweler? No. When you buy equity, why are you checking? Why are you gauging your performance? And let's mind it. And majority of the Indian public has not yet participated in the market. We know the numbers.
Yes.
Not even 3% of the saving has coming yet in the stock market. Even though we see that the inflows in the last 12 months have been very good in mutual funds. But if I take a 5-year view, cumulative, there is still net outflow from equities. Even though the absolute saving has gone up, absolute size of GDP has gone up, absolute size of financial saving has gone up, but net there is no money which has come in the equity. So this kind of a correction, keeping that the medium and long-term bull market is intact, is a fantastic opportunity.
So for those who always wanted to buy now.
Absolute. Buy now, buy systematically.
Okay.
And I'm saying don't be afraid. So I am not telling that, just because Madhu Kela said that 7,200 is a good point to buy, you put all your money at 7,200. I am saying markets have its own reason, and that we all make our assessment and judgment based on what are the variables which are available today. If the variables change, we'll change our opinion. But I am saying anyone who systematically invests through this year, I am saying specifically in this first 6 months, which is what I expect to be much more volatile, I'm sure he will make money in the next 3-5 years.
What's gone wrong with banks? I mean, if everybody is so optimistic about economic recovery and if the long-term trends for economy are looking strong, banks is the biggest proxy for any economic recovery. And banks are down 25 to 30%.
Yeah. So again, banks, clearly the big issue is the non-performing assets and the fear of those non-performing assets.
So do you think there is a fear in the banking system, or there is an absolute problem
I think there are a combination of both. There is definitely some absolute problem, but I think the fears are significantly exaggerated.
Okay.
So when I meet the analyst community today, even for private sector banks, they want to tell me that, whatever is their corporate and international book, you take 30% will be completely written off. You take 50% might be bad assets. And for a change, I actually did the number myself this time. Even if I take 25-30% off from the balance sheet, which is to be written off over next 3-4 years, some of these banks are very compelling opportunities from a 3-4 year perspective.
So your big call is that the selling in banks is overdone by banks?
Yes. Yes. And buy systematically.
Of course.
Can it get accentuated on the downside? The possibility is yes.
10-15% cannot be ruled out.
We have seen times when the same banks were trading at 3-time and 4-time book just few years back, or even few months back, they were at a much more respectable position. Now the pendulum of swing on the other side. So I would say that, banks, for an investor who has a 3-4 year perspective, it is better to buy bank stock than put money in bank deposits.
Fair point. That's a wonderful, comment. We broadly classify banks into two: PSU versus private. Let me classify differently: wholesale versus retail. Banks which will gain because of economy, banks which will gain because of consumption demand coming back. Which one would you bet?
Nikunj, buy the Reliance banking firm. At least let us do that job for the investors who are watching us. I don't have a specific advice to give on which bank should you buy and at what price should you buy, and my compliance doesn't permit me to do so. But for the people who are smart, they can figure out for themselves. But the people who actually want to give it to some professional, there are a lot of banking funds which are available. There are people whose portfolio is overweight on the bank stock. I think those are the places which retail investors should look to.
Where are you reasonably confident of earnings recovery, and where do you think the selling has been overdone? Is it IT or is it pharma?
I think, broad-based markets, as you said, clearly we discussed about banks. In some pharma names, even though, in pharma, we will have to start to distinguish now. So there was a complete bull run in pharma from 2008 when the market cap was 1 lakh crore and it went to 9-10 lakh crores for the sector as a whole. So in this time frame, whatever you bought in pharma, you made money. I think one has to start to differentiate, because the normal pharma companies which were like making money by just exporting to US and in a normal generic market, I expect that will become very competitive. Because now US FDA has come and already said that we will accelerate the process of giving approval to 10 months in 2017. That means more competition. But still, there is a lot of opportunity in the pharma companies which are going into complex generics, the people who are going to biosimilars, the people who are actually have approvals for a lot of complex drugs. So this pocket is going to be mixed. And again, you need an expert to figure out which is the pocket which will do well and which is the pocket which will be under pressure.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.